That's that. Okay, welcome back, everybody. Today we're going to be covering Chapter 4. It deals with gross income, and this time we're going to talk about the exclusions. Recall from Chapter 3, we were talking about inclusions. Now we're talking about the exclusions. So let's look at what our learning objectives are for this chapter. Let me just double check that we're recording here. Okay, sorry about that. All right, learning objectives. The first one, determine whether an item is income. The second objective, determine which major statutory exclusions are available to a taxpayer. Describe tax planning considerations for exclusions of gross income. Describe compliance and procedural considerations for the exclusions of gross income. So these are going to be our learning objectives for this chapter. Okay, let's first talk about some items that are not income. Okay, we'll start with unrealized income. Okay, so what exactly is unrealized income? So let's just start with an example of it. So if the value of a certain stock held by the taxpayer appreciates from $10,000 at the beginning of the tax year to $25,000 at the end of the tax year, then that $15,000 unrealized income is not subject to tax. Okay, so what we mean here that's unrealized. So that's just a holding gain because he has not actually just cashed in on a security. If he would do that, then he would be subject to tax on the gain. However, he did not. So it's just appreciated from $10,000 to $25,000. So that $15,000 unrealized holding gain on holding that security is not subject to tax. So that's unrealized income. Next, the self-help income. Let's look at an example of what self-help income is. Let's say if a taxpayer repairs his own car, for example. Instead of paying a mechanic, the amount saved is not subject to tax, right? So that's self-help income. So if you just do something yourself, like this summer, I built a fence in our backyard. So obviously the self-help income. So obviously we increased the value of our home, but it's not subject to tax right now because that's just self-help income. Rental value of personal use property. So let's give an example of that. The rental value of a personal residence occupied by the taxpayer is not subject to tax, even though the taxpayer could have rented the house. The selling price of property, so the gross sales price of property. An example of that is only the gain. For example, the selling price less the cost of a sale and tax adjusted basis. And a taxpayer's disposition of property is going to be subject to tax rather than the entire sales proceeds. So only the gain. So you're skin in the game, meaning the amount you paid, your cost that you incurred to have that house or that piece of property. That's not going to be subject to tax. Only if your property appreciates from the time that you purchased it to the time that you sold that. The gain is what's going to be subject to tax. Okay, let's look at some of the major statutory exclusions here. You can see here the list. We have gifts, life insurance, welfare, certain scholarships, certain payments for injury, certain employee benefits, certain foreign income, tax-exempt interest. Here's some Series EE bond interest. We talked about that on the last chapter. Leasehold improvements, meritorious achievements awards, certain divorce payments, gain from sale of home, Roth IRA distributions, COD, which means cancellation of debt, and Social Security benefits. So these are going to be some exclusions, some of the major statutory exclusions from gross income. Okay, so let's talk about some reasons for statutory exclusions, okay, before we get into talking about a little bit of the ones that are excluded. So the reasons for statutory exclusions, the first is benevolence. So what do I mean by benevolence? For example, social generosity or sympathy. So an example of benevolence is the exclusion of payments for sickness or injury. Okay, so we have some sympathy or some generosity for making these exclusions for certain participants in the tax code. Another reason for statutory exclusions would be the economic incentive. An example of economic incentive is exclusion of certain scholarships. This encourages education, so economic incentives, so trying to push people into education. Okay, let's talk about gifts and inheritances. Okay, so transfers of property with donative intent, whether made during the life, which would be a gift, or at the death of the transferor, which would be an inheritance in that case. These are going to be excluded from gross income. Okay, now income earned from such property is going to be subject to the regular income tax rules. Okay, so let's look at an example here. So let's say the mother gives a daughter bonds having a value of $100,000. The value of the gift, $100,000, is excludable from the daughter's gross income. Okay, any taxable interest earned by the daughter subsequent to the transfer is included in the daughter's gross income. Okay, so there's an example of how the gifts and inheritance works. Okay, let's talk about life insurance proceeds next. Okay, so life insurance proceeds, which are paid by reason of death of the insured, are generally non-taxable. Okay, so any amounts received in the excess of the face amount are taxable as interest. Okay, so once again, the life insurance proceeds paid by reason of death of the insured are generally non-taxable, but any amounts received in excess of the face amount are taxable as interest, right? So let's look at an example here of the life insurance proceeds. So let's say a father dies. The son is named the beneficiary in an insurance policy on the life of the father in the amount of $1 million. Okay, the son receives the $1 million proceeds free of income tax. If instead of receiving the proceeds in a lump sum, assume that the son receives $120,000 a year for 10 years. Okay, so the excess of the the excess of the 1.2 million received over the million, which is the face amount, 200,000, will be taxable interest on a straight line basis over a 10-year period. So the difference, not the million, but the 200,000, will be taxed on interest on a straight line basis over 10 years. Okay. Now, if the life insurance policy is purchased from another individual, the owner treats the proceeds as a gain from investment. So what we mean here, for example, the excess of the proceeds over the acquisition cost plus premiums paid is going to be a taxable gain. Okay, certain policy acquisitions related to the partnerships and closely held corporations are excluded from this rule. All right. So let's look a little bit here on the slide here what it says. So generally face value of the life insurance proceeds paid upon death are not taxable. Income to recipient, we established that in our example earlier with the father dying and his son was named the beneficiary of the $1 million life insurance policy. The exception, if a taxpayer purchases a policy insuring another, then the tax-free portion limited to purchase price plus additional premiums paid. And it says here, also if amounts received are greater than face value, then the excess is taxable income. So once again, we established that in our example with the father and the son. Now it says here, life insurance is generally sold for a lump sum prior to death, or if the life insurance is sold for a lump sum prior to death, sorry about that, of the insured, then taxable income for amount received greater than premiums paid. So once again, if you receive money greater than the amount of the premiums paid, then that's going to be considered taxable. Okay. There's an exception to this rule. If sold for accelerated death benefits, then the amount received is not taxable. Okay. So in this case, the insured must be terminally ill, and the doctor must certify that death is going to be reasonably likely within 2 years. Okay. Payments must be made to the terminally ill, and the tax-free payments are going to be limited to $360 a day. And this was at a time in 2018. Okay. Okay, no loss recognized if policy surrendered and sum of the premiums is greater than the cash surrender value. Okay, dividends earned on life insurance policies are non-taxable to the extent they are equal to or less than the premiums paid. Interest paid on dividends left with the insurance company is going to be taxable. Okay. Okay, let's talk a little bit about the awards for meritorious achievement. I know I always twist that word up, so I apologize about that. So it says here that awards are generally taxable, right? Awards for religious, charitable, scientific, educational, artistic, literary, or civic achievement are going to be excluded from income only if the taxpayer did not enter the contest or proceeding. It is not required to perform the substantial future services and designates a qualified charitable organization or governmental unit to receive the payment. Okay, so let's give an example about that. So, if the taxpayer receives the Nobel Prize in recognition of her discovery of the cure for cancer, the award will be included in her gross income unless properly assigned to a qualifying nonprofit organization. So, pretty much long and short here, if you win a prize, if you pass it on to a non for profit, so you forego the prize for pretty much, then it's not going to be taxable. If you do take the prize, then it will be considered income. Okay, next, let's talk about some scholarships and fellowships. So scholarships is obviously for tuition, for fees, books, supplies, and equipment only, right? These are going to be excluded for degree candidates. Okay, so it says here the definition of a scholarship is paid to allow students to obtain a degree at a college or a university, right? And it says here also that the scholarship money that covers room and board and laundry. So let's look at an example here, okay? Let's assume that the taxpayer receives a full ride scholarship to play football at a large university. The amount of the scholarship allocable to tuition, fees, books, supplies, and equipment will be excludable from the taxpayer's gross income. Any additional amounts received for room and board will be included in gross income. Okay. Okay, let's talk a little bit about some distributions from qualified tuition programs. Okay, so these are going to be your Section 529 plans and the qualified tuition plans known as the QTPs. Okay, and these are usually administered by individual colleges or by states. Okay, so they differ by colleges and states for these Section 529s and qualified tuition plans. Okay, distributions made from qualified tuition programs are taxable only to the extent they exceed qualified higher education expenses. Now, these expenses include room and board if the student is at least a half-time student. Okay. So once again, we see here what the qualified expenses are: tuition, books, fees, supplies, room and board, and no income limitations. So even wealthy taxpayers can participate, right? So that's nice. So all people that make from as little as $10,000 a year to $10 million a year, everyone can participate in these Section 529s and these qualified tuition plans. Okay, so that's nice. Okay, let's talk a little bit about a little more about some other issues with the qualified tuition programs. Okay, so the owner of the account, meaning the person who holds this investment account of either the qualified tuition plan or the Section 529, they can actually redirect the benefits to another person within their family, right? So it has to be someone within their original household, right? So an immediate family member. And that family member can actually still use the funds tax-free if it's used for educational purposes, right? So that's a nice little thing about the plan too. So say if I would set up a Section 529 plan for my daughter, and she decides that she doesn't want to go to school, and then later myself and my wife decide that we want to go back to school, then we can just redirect the funds to us, and not be penalized for it as long as we use them for school. It's also important to note that if no one in the family decides to go to school, so you've already been putting money into this plan, you can actually just take the money and draw it out, and there is a penalty, and you have to pay taxes on it if you do that on the gains. So that's the little downside to it. So it's just kind of in the same manner as pulling money out of a 401k prematurely. There's a penalty for that. So, and I want to say it's 10%. I'm not totally sure on that. I just wanted to point that out, that there is penalties if you pull the money out and it's not used for educational purposes. Education credits reduce any exclusion under Section 529. Payers can make a large gift into the plans and can treat it as having paid over 5 years. So, in other words, it makes it possible to go below the 15,000 per person threshold for tax-free gifts. So that's also nice. Okay, let's talk a little bit about payments for injury and sickness. Okay, Section 104A of the Internal Revenue Code. So, payments for injury and sickness, amounts received as compensation for injury and sickness are going to be excluded whether paid by insurance or otherwise. The exclusion only applies to personal physical injuries or physical sickness. Most damages on non-physical injuries are going to be taxable. Punitive damages are taxable per statute. Okay? So, for example, a taxpayer receives $10,000 from his health insurance company to reimburse cost of a recent hospital stay. Well, this $10,000 amount is not going to be subject to tax, okay? Now, payments under a disability income policy are non-taxable if the policy was purchased by the taxpayer. They are going to be fully taxable if the policy is purchased by the taxpayer's employer. Now, any reimbursed medical expenses cannot be deducted as an itemized deduction, okay? Here it says punitive damages are always taxable even if physical injury is involved. So just remember, punitive damages always subject to tax. The amounts received under accident and health insurance policies are excludable even if benefits reimbursed for lost wages. So, for example, short or long-term disability insurance paid by the employee and with the premiums not excluded from wages. Long-term care payments are excludable up to $360 per day for 2018. If you recall, we got this amount earlier in the lecture. And then medical expenses paid by a health insurance plan cannot be deducted by the taxpayer. Okay, let's talk a little bit about employee fringe benefits, also known as EE fringe benefits, okay? The general rule is anything paid to or on behalf of an EE is includable in income. The exception is certain EE fringe benefits, right? So it says here the employer can deduct the expenses, but the EE does not have to include an income. Examples of excludable fringe benefits: employer paid insurance, parking, professional license fees, training, gym memberships, etc. So once again, employer paid premiums on health, accident, disability, and qualifying group term insurance are excluded from the employee's income. So let's look at one more example. So the taxpayer's employer pays the entire premium for health and accident insurance on the taxpayer and her family. This amount is $350 per month. So the entire annual cost to the employer, $4,200, is going to be excluded from the taxpayer's gross income. So that's also nice. So as you can see here, that's a great benefit of getting a job with an employer who's going to provide you these types of benefits, as you have access to the benefits and the right to use these benefits, but you're not going to be subject to tax for having that access to those benefits. So that's always nice. So always try to find a job with really good benefits. The benefits from non-discriminatory self-insured accident and health plans are also excluded from the employee's income. Okay, let's talk a little bit more about the fringe benefits of insurance. So once more, most employee life insurance premiums paid by the employer are taxable to the employee. An exception exists for group term life insurance coverage not exceeding $50,000 per employee. So premiums for coverage exceeding $50,000 will be taxable to the employee. Different calculations may exist for key and non-key employees if the plan is discriminatory. Okay, let's talk about Section 132 of the code dealing with fringe benefits, okay? So the employer may deduct expenses The double E generally does not have to include an income, okay? So it generally cannot discriminate, meaning the benefits available only to highly compensated and still keep excludable treatment. They can discriminate on working condition and qualified transportation fringe, and that's going to be described on the next slide, so we'll get to that. Okay, so the following benefits may be excluded from an employee's gross income, okay? We'll start with just saying no additional cost benefits. So an example of this is like standby flight benefits for airline employees. So unused employee services, hotel rooms, airplane seats. It says here we have employee discounts, limited to 20% on services, no discounts for real or investment property. So 20% discount on legal services for law firms, receptionists. The next we have a working conditions benefit. An example of this would be like free snacks at a place of employment, or it says here outplacement or a company car. The de minimis benefits, which would be, for example, like a free holiday turkey, or employee awards, section 74, free coffee, Christmas party stuff of that sort. Another one that's not listed here, recreation and athletic facilities. So the free use of the employer swimming pool or the gym, for example. Qualified transportation fringes, so public parking, public transportation, and or commuter vehicle exclusion up to $260 per month, okay? Meals and entertainment. Taxpayers who attend and pay for business meals with customers or colleagues do not have to include cost of meal consumed in his or her income. Expenditures cannot be abusive. So meaning that we just cannot have outrageous costs of meals and entertainment. It's got to be within reason of the purpose of the meeting, okay? Next, adoption expense. Employee can exclude up to $13,840, and this is a 2018 threshold of qualified adoption expenses that are paid by the employer. Exclusion phased out between the $207,580 and the $247,580. Okay. Another one, employee death benefit. This is where the taxable wage or bonus due to employee, unless it is clear and that the employee has been fully compensated, and amounts paid to family are out of sympathy and generosity. Okay. Dependent care, employer can provide up to $5,000 a year, excludable by employee if the expenditure would have normally qualified for the dependent care credit. Okay. Cafeteria plans or flexible spending accounts. The employee can elect to take compensation in cash or have money set aside to pay for benefits. If the employee selects cash, then the amount is taxable. If the employee selects statutory non-taxable fringe benefits, so for example health insurance, then amounts are excludable. So that's nice. So these are all pre-tax items, right? So they're not entered into determination of our income. Qualified transportation fringe. For example, public transportation passes or free parking. Once again, these are limited to $260 a month, as we talked about that earlier. Okay, a little more. Recreation and gym memberships, educational assistance. This is limited to job-related education and training. So the employee can exclude up to $5,250 for tuition, books, and fees for undergraduate or graduate classes. Next, meals and lodging. We'll talk more about this in depth on the next couple slides here. So let's talk about this. Beginning in 2018, the employers can no longer deduct expenses associated with employee transportation, parking, recreational facilities, and de minimis benefits. Okay, the employers may deduct 1/2 of the net cost of operating employee eating facilities. So just keep that in mind there. So a little bit's been amended there in 2018 in terms of what the employer can actually deduct as an expenses associated with these types of services. Next, the employee awards. Certain employee achievement awards and qualified plan awards are excluded from the employee's gross income. So let's say that a taxpayer receives a watch, and let's just say, for example, it's worth $350. So once again, the taxpayer receives a watch from his employer for his 10 years of service, right? So that's his award for the recognition of 10 years of service. The value of the watch, in this case $350, is going to be excluded from gross income. So that's nice. We can receive an employee award without being subject to tax within our gross income. So okay, let's go ahead and get off section 132 now with the fringe benefits and get a little more into the meals and lodging. Okay, so these are also going to be excluded from an employee's gross income. They are employer provided meals and lodging if they are provided on the employer's premises for the convenience of the employer, okay? An additional condition for excludable lodging is that the employee is required to accept the lodging as a condition of employment. So once again, this is for the convenience of the employer here, right? So that's why he's putting you up and the lodge and giving you food. So an example, the taxpayer is the day restaurant manager. She is required by her employer to stay on the restaurant premises during the hours of 8 a.m. through 5 p.m. to handle all management responsibilities. The employer provides the taxpayer her noon meal for each working day. The value of these provided meals is excluded from the taxpayer's gross income. So that's nice, get a free meal. And once again, see in that example that the employer is providing the meal for the employee for their benefit. They don't want that employer or that employee to leave the premises at any point during operational hours in case something would come up that would need his or her attention. So once again, that's for the benefit of the employer. Sorry, excuse me. Now, beginning in 2018 and until 2026, employers may deduct 1/2 of the cost of these meals. Now, prior to 2018, employers could deduct the full cost of these meals. So now it's only going to be half the amount. So let's look at some more examples with the meals and lodging. A fireman must live in and stay close to the station during his or her shift due to the need to be close to necessary equipment and to respond quickly to emergencies. A hospital typically provides free or highly discounted meals to personnel since they need to be readily available in the event of a sudden medical event. So once again, just like the example about the day restaurant manager needing to be there through operational hours, these are just some more examples of how it's for the convenience of the employer in order for these meals and lodging examples. So once again, there's one with the firemen and then with hospital staff. So let's talk a little more, just one more little thing about meals and entertainment here before we move on. The value of the employee's meals and entertainment that is paid for by the employee are non-deductible by the employee. Okay. Now, however, an employee is not required to include a reimbursement in income if the expenses are job related and the employee is required to provide an accounting to the employer unless they represent compensation for services. Okay, now let's talk a little bit about dependent care. Non-discriminatory dependent care provided by the employer is going to be excluded up to $5,000 annually. We talked a little bit about that earlier. I just want to give another example. So let's say the taxpayer is a nurse and the hospital where she is employed provides free child care for the taxpayer's 4 children. The value of this child care is going to be $6,000. The taxpayer must include $1,000, $6,000 minus the allowable dependent care exclusion of $5,000. So that $1,000, anything over that $5,000 threshold must be included in gross income because the value of this service in this case was $6,000, which is $1,000 over the $5,000 threshold. Next, the adoption expenses. An employee is allowed up to $13,840 per child exclusion for qualified adoption expenses that are paid by an employer. The exclusion is not limited to expenses incurred for a child with special needs. A phase-out is provided for taxpayers at high AGI levels. Once again, AGI is adjusted gross income. An alternative adoption credit is going to be discussed in Chapter 14, okay? Next, educational assistance. So an exclusion of up to $5,250 is available for employer-paid qualified educational cost reimbursements for undergraduate and graduate. Once again, we touched on these. Cafeteria plans. Employers may provide qualifying cafeteria plans through which employees can select from cash or non-taxable fringe benefits without destroying the exclusion for the non-cash benefit. An example of this is the taxpayer's employer provides a qualifying cafeteria plan under which the taxpayer may choose cash or health accident insurance premiums. Okay, to the extent the taxpayer selects the non-taxable fringe benefit, nothing is included in the taxpayer's gross income. Now, of course, to the extent the taxpayer selects cash, that amount is going to be included in gross income. Now, cafeteria plans have two basic designs. Supplemental wage plans involve additional compensation in the form of fringe benefits. Wage reduction plans allow employees to reduce wages to pay for fringe benefits. Wage reduction medical reimbursement plans are a common form of cafeteria plan. Problems can arise from the employees in accurately determining medical expenses a year in advance. Now, employers may encounter problems with differences in timing between benefit payments and collections from employees. So, what are some of the advantages of fringe benefits? Non-taxable fringe benefits are preferable to additional cash compensation when the cash would be used to buy the same benefit anyways. So, the tax on the cash compensation is saved by the taxpayer. Okay, let's talk a little bit about foreign earned income. Okay, and particularly what's going to be excludable, right? So, general rule, U.S. citizens are taxed on all income, even if they earn it in a different country. Now, the foreign country could also have those earnings subject to tax, right? So, if you're earning money in another country, then it could be subject to double taxation. The first layer in the foreign country in which you earned it, and then another second layer within the United States. Now, it's nice to know that the U.S. tax system does provide a relief to the double taxation. So the taxpayer can select either a foreign tax credit, known as an FTC, or foreign earned income exclusion, okay? Okay, so foreign earned income exclusion. Let's move down this slide here. So U.S. citizens can exclude $104,100 of foreign earned income in 2018 in lieu of taking the foreign tax credit on this income. Okay, so once again, U.S. citizens can exclude a little over $104,000 of foreign earned income in 2018 in lieu of taking the foreign tax credit on this income. Now, if the foreign tax rate is higher than the U.S. tax rate on the same earned income, so once again, if the foreign tax rate is higher than the U.S. tax rate on the same earned income, then the foreign tax credit will be preferable. Now, if the U.S. tax rate is higher than the foreign tax rate, the foreign earned income exclusion will be preferable. Okay? So let's just say that again. So once again, if the foreign tax rate is higher than the U.S. tax rate on the same earned income, the foreign tax credit will be preferable. On the other hand, if the U.S. tax rate is higher than the foreign tax rate, the foreign earned income exclusion will be preferable. Now, it's important to note that both spouses may take the exclusion on a joint return, and that's assuming that both spouses have sufficient foreign earned income. Taxpayers changing from the exclusion method to the credit method may not elect the exclusion method again for 5 years without IRS approval. So you can't just go back and forth. Once you make the change, you have to have the approval of the IRS to do so. The exclusion must be prorated if the taxpayer is not a resident of one or more foreign countries for the entire tax year or 330 days during 12 consecutive months. So you really have to spend a lot of time in another country for this to even be relevant. Deductions directly attributable to the excluded foreign income are disallowed. Okay, an additional exclusion is going to be available for certain living expenses in excess of the governmental standard. Okay. Once again, this slide here, sorry, is a little out of order. Same thing about talking to be able to claim the exclusion. Once again, the taxpayer must be a bona fide resident of one or more foreign countries or be present in the country for 330 days within 12 consecutive months. So considering that there's only 365 days in a year, I mean, you're spending most of your time, about 11 out of the 12 months, in a foreign country working. So income from discharge of debt. Okay, what are the different types of income from discharge of debt? So we can receive a gift, a bequest, the COD, which is the cancellation of debt. Cancellation of debt. Excuse me. Or the change in the purchase price. Now these are all different types of reductions of debt here. Okay, so the general rule for the income from the discharge of a debt is that the income is recognized on a discharge of debtness, right? So in other words, these are going to be subject to tax. There are certain exceptions that exist, okay? Let's say that the discharge is a gift or the discharge is a bequest, right? Forgiven through a will. The discharge occurs in bankruptcy. The discharge occurs when the taxpayer is insolvent to the extent the forgiveness does not make the taxpayer solvent. The discharge of a student loan occurs for certain approved post-education employment. The discharge of student loan on account of the student's death or home mortgage forgiveness through 2016. Okay, it's important to note here when debt forgiveness is not recognized as income in a bankruptcy or insolvency situation, the taxpayer must reduce tax attributes, for example, net operating losses, general business tax credits, capital loss carryovers, basis of taxpayer's property, and even the foreign tax credit carryover. So once again, the taxpayer must reduce these tax attributes in an amount that is going to be equivalent to the forgiven debt, okay? So in other words, it's going to be like a washout. You're going to still have the same tax liability because they're making you reduce these other benefits you would receive because you received another great benefit for the forgiveness of debt. So really, it's nice you don't have the debt on your backs, but they're gonna try to still get you to the same income tax liability to try to get as much money from you as they can. So once again, we've talked about some of these exceptions here. Discharge occurs in bankruptcy, taxpayers insolvent at discharge. Once again, forgiveness of student loans. Forgiven amounts are not includable if the taxpayer works in certain professions and specified public service sectors. So like if you're in public service, like if you're a teacher or something of that sort, then a lot of times you can make a standard payment on it or a certain type of a payment for 10 years. And then after you make those payments for 10 years, then anything over and beyond what you still owe is going to be forgiven, and you do not have to include that as income. So that's nice. Discharge of student loans on account of the student's death is not taxable, obviously, because they're no longer in existence. Okay, let's just talk a little bit more about some exclusions from the gain of small business stocks. Even though I know it's not shown here, I just want to touch on a few more things here while we're in this chapter. So let's talk again about exclusion for the gain from small business stocks. So 100% of the gain on the disposition of certain qualified small business stock may be excluded by non-corporate taxpayers. So meaning when we say disposition of a certain qualified small business stock, means if we sell that or dispose of that stock, right? So the stock must have been acquired after September 27th, 2010 and be held for more than 5 years, okay? A qualified small business for this purpose is a C corporation with no more than 50 million of gross assets. Okay, and of that, with 80% of the value of its assets used in the active conduct of a trade or the business. So we need to be actually using these assets to produce the revenue that we're in, whatever trade or business we're in. Corporations in the following industries are excluded from eligibility: professional services, financial services, hospitality, and mining, oil, and gas production. Now, the amount of excluded gain per issuer in a taxable year is going to be limited to the greater of 10 million less prior year exclusions, or 10 times the aggregate adjusted basis of the stock disposed of by the taxpayer. And this is going to be computed on a fair market value basis. Now, for qualifying stock purchased from February 18 of 2009 through September 27th of 2010, the exclusion is to 75% of the gain. Now, for qualified stock purchased from August 10th of 1993 through February 17th of 2009, the exclusion is 50% of the gain. Okay, let's talk a little bit about tax planning considerations. Okay, let's start with the first one of employee fringe benefits. So employers must carefully evaluate both taxable and non-taxable employee fringe benefits from the employee perspective, as the employer is generally able to deduct both as forms of compensation, right? They need to provide providing a cafeteria plan may provide the best alternative so that employees can select the benefits that they desire rather than the employer making that decision. Next, the self-help income and the use of personally owned property. So the tax law encourages the ownership of personal residence over the rental of the same property. Deductions for carrying costs, meaning interest and taxes, are available for purchased residences, while rent on personal residences is not deductible. Okay, let's talk a little bit about compliance and procedural considerations, okay? Withholding and W-2 reporting for fringe benefits vary with the type of benefit. Penalties are provided for employers who fail to withhold or report properly. Non-taxable fringe benefits are not reported by the employer on the W-2 or by the employee on his or her tax return. Okay, well, that wraps up Chapter 4, Gross Income Exclusions. I hope I explained everything as clearly as possible. As always, if you have any questions or concerns about any of the content, please feel free to reach out to me, and I'll try to get back with you as soon as possible. I apologize again for a delay in getting this lecture up. I've just had a lot going on. I really want to speed these lectures up and get them up a little earlier in the week, and that is my goal still. So just bear with me. So that's it for Chapter 4. I hope everyone has a good day, and thank you again for your time. And be on the lookout for Chapter 4 homework and quizzes. I'll be getting them up here shortly as well. Thank you.